National Real Estate Trends Update. We have a lot of great information for you guys. Nick Elder with Ironton Capital. I've got Lon Welsh here with Ironton Capital. I've got Joe Mass here with Synergy One Lending.
One of the great things about mortgage rates is that they are priced by the 10-year Treasury plus a risk premium. And you can see the risk premium by year on this chart, and the gold line on the bottom is 2026. So you can see that the market's perception of the risk of buying mortgage-backed securities is declining a little bit over time. That's led to better pricing. Joe, is that because the refinancing risk is less, or what do you think is driving that?
That's exactly it. So the phrase risk premium, a lot of people, when we started talking about this in 23 and 24, a lot of people thought that meant, oh, mortgages are more risky, we're going to have a foreclosure crisis. Not necessarily. Mortgage-backed securities have all sorts of risks, like foreclosures, like early payoffs, like early payment defaults. And when rates spiked so high in early 22 or mid 22 and into 23, there was a lot of concern that rates were going to come right back down and those loans would pay off very rapidly. Well, what we've seen is inflation has remained sticky, interest rates have remained increased, and the risk of those loans paying off early has come down, which if you look at that purple line, there was a very significant risk premium in 2023. That's come down a full 100 basis points from more than 300 basis points now to roughly 200 basis points. That's led to a lot of relief in mortgage rates. Now, you're probably sitting at home thinking about relief. Interest rates are 6.5, 6.6, 6.75. That's true. Had we not had the relief reflected here on this spread, we'd be talking about rates of 7.5, 7.7 in some cases.
So this is really positive.
Yeah, this is good news, I think.
A lot of good news there. So eventually I'm expecting the 10-year is going to come down a little bit, and I'll talk about why that is here in just a second. So I wanted to get some history because rates spiked when this current Mideast conflict started up, and I wanted to take a look at prior geopolitical crises and understand what kind of impact they had on mortgage rates, so we'd have a little bit of predictive power, or at least some range of expectations with this particular crisis that we're lurching our way through right now. So if you take a look all the way on the left-hand side, and the fine print at the bottom, you see 2001, the 9/11 attack, and the next one is 2003 when the U.S. invaded Iraq. So I'm going to use 2003 as an example. So if you look at the left side of the chart, you can see where it says number one. Before the invasion, mortgage rates were 5.6%. After the invasion, when the headlines were nonstop about here's what's going on in the Middle East, you can see that they went up by 1/3 of a point. So whenever there's risk in the market and some sort of war, usually interest rates will go up. So then what happens when the war is over? Do the rates normalize to back to where they were before, or what happens? And in this particular example, the rates settled at 0.2% less than they were before the conflict started. And interestingly enough, 14 out of the last 17 crises we've had in the last 25 years, the rates wound up being a little bit less when the thing was finally resolved, right? I'm not able to explain exactly why that is. I've got some of the factors. I'll share all those with you. Joe will probably have the things I'm missing. So what we've got on the left-hand side here is taking a look at how much did the rates go up for each of these different crises that we had. So if you look in the upper left, you can see for 9/11, they only went up like a tiny bit. But for the U.S. invasion of Iraq in 2003, rates went up by 0.3%. Pretty healthy. Actually, across all of these 17 different crises, it was among the highest. The spike in rates we've seen during this current Iran issue is actually the highest that we've seen in a political crisis in the last 25 years, something that I've not seen reported in the media anywhere. I don't know why nobody's looking at this. Kind of an interesting fact. On the right-hand side of the chart, we're looking at when that crisis was finally resolved, how much rate relief did we receive? So what you can see is that during the 2023 Israel-Hamas war, third from the bottom, there was a gigantic decline. A couple different factors probably went into that. It wasn't just relief from after the war, but also some broader economic things kind of distorted that one. But generally speaking, you can see that rates generally go down by quite a bit. Another thing that's interesting about this chart is that not every crisis in the media has an equal effect on what happens with the mortgage rates. So if you look on the left-hand side near the top, 2006, we had a war in Lebanon. 2008, we had a Georgia war with Russia, and the rates didn't really change at all. During the 2013, Syria, the chemical weapons, Syria, not much of an impact there either. So not every conflict has an equal amount of impact on the mortgage rates. But this one was larger than average. Joe, do you have any thoughts on this chart?
I want to add one thing. I think you're exactly right. Not every conflict has an impact that rates go up, which we can see if you look on the left-hand side of the chart, there's not as many lines going to the right. But virtually every conflict has a positive impact that decreases rates 14 out of 17 times. So not every time, but most times when the conflict is over, you see an improvement. And you can kind of see some correlation in the amount that rates go up. There's a correlation to how much they go down, and they go down even a little bit further than where you were at before the conflict. So I'm hopeful, maybe not optimistic, but hopeful. And hope is not a strategy, but hopeful that this Iran thing will get wrapped up here at some point in the future, and we'll see an improvement of not just the 0.5% back to where we were, but maybe a 0.7, 0.8, 0.9% improvement from where we're at currently. So I think that you really hit the nail on the head. The increase in rates is not created equal on every conflict, but the improvements in rates is very, very consistent that it happens 14 out of 17 times after the geopolitical event is over. So I'm optimistic that'll remain true this time.
So when we think about mortgage rates, they're really the two components of the 10-year treasury plus the risk premium. If I go back, you can see that the risk premium has been pretty consistent since January. So the risk premium itself hasn't really been impacted by the war in Iran. It's been more an impact of the 10-year treasury is where we've seen that at. So I wouldn't expect like when the war resolves, the risk premium is going to decline to say 2021 levels just overnight. That's not, I don't think that's likely to happen. I'm not an economist or anything. Just play one on TV. But I do think the 10-year treasury could have some room to go down. Is that kind of what you see as well?
Yeah, I think you're exactly right. The 10-year treasury will have some room to improve, particularly as inflation comes down if the Strait of Hormuz is open.
So for a lot of you guys, you may be thinking about different types of refinancing for commercial assets as well as residential assets. This might give you some ideas just to think about from a forecasting standpoint that you're not seeing in the media all that much.
Mm-hmm.
So why does this happen? Conflict creates uncertainty. The market will worry about risk and supply. When there's uncertainty, the market interest rates will have to go up to compensate investors for the increase in perceived risk. Eventually, we get to some sort of a ceasefire and we say we're done with this war, and there's a de-escalation, the markets will stabilize, and then there's usually more demand for safe, or what's perceived as safe bonds. In our case, the 10-year treasury is about as safe a bond as anyone has anywhere on the market.
Yep.
Bond yields tend to fall and the mortgage rates will follow, like we talked about. So that's kind of the emotional process that the market goes through. So one of the things that's useful about this chart is it shows you what the average rate is by mortgage interest rate class. If you take a look at the purple line, you can see that the number of people who've got a mortgage rate above 6%, just as recently as 2022, was like close to like 5%, and now it's close to 25%. So that's important for us in real estate because a lot of people, if they're on a 3% mortgage rate, they're not very excited about selling and buying a new house and doubling their interest rate. But every time someone has to do something that results in a higher rate, there's less friction to them becoming a seller sometime in the future. And Joe, are you seeing this in the behavior from the people that you talk to every day?
100%. And I want to draw everybody's attention to the black line and the blue line. These are rates below 3% and below 4%. Now, Lon, Nick, let me ask you guys a question. 5 years ago, did you hear anybody say, I've got a mortgage rate of 2%. I'm never moving? Did you guys ever hear somebody say that?
Quite a bit.
Yeah. Now, a lot of people said, oh, they got a 2% mortgage rate. They're never moving. I'm taking them off my database and I'm never going to call them again because I'm going to replace them with somebody else. Well, if that were true, that black line and that purple line would remain fixed, right? It's not true. The reason it's not true is because life goes on. People still get divorced. People still get married. People still have babies. Deaths happen. Births happen. All these different things happen. The reason I bring that up is just because when somebody in your database says, I have a 2% mortgage rate, I'm never moving, stay close to them. Continue to interact with them. Continue to make your forward calls because you never know when that person with a 2 or 3% rate, A, could refer you, or B, might have a change in their situation. So I think a lot of us kind of take that objection. I have a 2% rate, I'm never moving, and we say, okay, I'm never going to follow up. Please continue to follow up, guys, because 50% of people are in that demographic below 4% rate. and that number is actually falling because life goes on, that people are needing to move. So don't take those people off your database. Lots of opportunities there.
Absolutely. Just never know what's going to happen.
Mm-hmm.
So if you ask housing economists what's going to happen to mortgage rates for the balance of this year, they mostly think things are going to be steady. I think that that's probably a good thing to build your economic model around. I do think there's a little bit of downward pressure because of the war resolving and rates going down because of that. But that's the only reason why I think rates would go down. Otherwise, I mean, what do you think, Joe?
We borrow an awful lot of money as a country, and even though the risk premiums are improving, this war is going to have to be financed. I think 6.5 to 6.75 by the end of the year could be very realistic. But I have been wrong before.
Yeah, I don't think you're going to see a whole ton of change. So rates are what, 6.5, 6.6?
Yep, as of today, that's right.
So from a long-term perspective, it's higher than it has been, but it's not the end of the world by any means. MBA is the Mortgage Banker Association, so it's a whole nation's worth of guys like Joe Massey, and they ask them how many mortgage apps did you take this week, and it gives us this index. You can see in the heavy blue line on the left-hand side chart, that's the number of purchase applications, and it's been above the rate of the last 2 years, but it's not on fire by any means. Any sort of color on that from what you see day to day, Joe?
Yeah, what I would see from this, and this is what I experience every single day, if you're an agent or you're talking to people and it just feels slow, this is why. There's just not as many transactions going on as we were accustomed to 3 years, 4 years, 5 years ago. I think this is actually pretty normal. And those bottom four lines, that's 23, 24, 25, and the dark blue is 26. You need to learn how to operate in this market where there's not going to be 6 million sales. There's going to be 4 million sales, certainly I think this year and probably next. That means you might have to outwork the market. You might have to outwork the other competitors in your market in order to remain really successful. The good news, you can outwork the market. But if you're waiting for a pickup to suddenly we're going to go to 6 million sales a year, that's probably not going to happen. So I think this is very a good reminder of how we should run our businesses.
Absolutely. And I recently got this chart on the right, so I thought I'd include it for you guys. This just shows the predictive power of mortgage applications. Mm-hmm. So if you take a look at the blue line, the number of mortgage applications by week, and then if you take a look at the number of home sales and you just adjust it by 1 month, because there's kind of a lead time between the mortgage app and when you close on the house, you can see the correlation between these two lines is incredibly strong. So it's one of the very best predictors of what sales are going to look like in 30 to 60 days.
Yep.
All right, consumer confidence. You might recall that consumer confidence hit a record low. I mean, with data going back to the 1950s, back in May, but it was up in June, and we just got the data in July. I just got it like yesterday, so it's not in this presentation, but the July data was even better than June's. So it's not like it's, like at 100, it's like at, 51 or something, but at least it's starting to come up. So that's a really good sign. People don't usually want to go buy a house or make another large investment if they're not confident about where the economy is at. Out of this. So the negativity in the consumer sentiment seems to be highly correlated to when ChatGPT and the other AI models got released. If you take a look at the chart on the left, you've got a solid line there about 2023 when the first AI model was broadly introduced to the public. And the number of people worried about losing their job in the next 5 years went from about 17% to 22%, like nearly overnight. So part of the negativity in consumer confidence is not just the war going on, inflation, or high gas prices or food prices. It's also uncertainty about, will I have a job and be able to afford that mortgage payment if I sign up for something new? What's interesting is on the chart on the right, this is some new data that just came out a week or so ago, is that the firms with a high rate of AI adoption, at least with their public-facing announcements, are still hiring people. The firms that are not making public announcements about AI and its implementation are the ones that are static or losing jobs on average. So at the moment, at least, AI adoption is not correlated to job loss. It's actually correlated to growth in job gain. Now, will that continue to be the case? I don't actually think so. I think that this is early days. We're like in the, we're probably in the third out of the first inning here. But at least at first, there's not a lot of indication that you should be worried about that.
I think I want to touch on that real quick because I think this is it really just shows why it's so important to go beyond the headline, because you'll go in the headline and it'll say Oracle, as a result of AI, is firing 10,000 employees. But then you look at the last 3-4 years and they've hired 40,000 people, right?
Right.
And
So there's still plus 30.
Yeah.
Right.
And so a lot of that could be because they're ramping up for AI adoption. They're trying to scale, right? So it really helps to go beyond the headlines, especially when it comes to this. It can kind of seem like doom and gloom, like everybody's getting laid off. But I think in reality, there's a lot more job creation than destroying of jobs as a result of the AI, just like this chart highlights.
Yeah, definitely. So I thought it was interesting finding. I thought you guys would find this of interest.
Yeah.
There's a lot more search traffic about, is AI going to take my job, than there has been in the past. Early days, eventually people are going to find out I'm not going to lose my job. And this is going to be a word that's going to blow past us, but we're still, I think, in the hurricane of anxiety at the moment.
We need to get that. We need to get
slides.
We need to get the top answers from ChatGPT here. We need to get what are those answers that AI is giving them, because that'd be a funny little, probably comedic relief for a lot of us here on this webinar.
Yeah. Can you go back one slide more? This slide on the right. If you're listening and you have a young person that lives in your home, a 20-something, a 25-something, we all know now that the average age of a first-time home buyer is approaching 40 years old. If you have a young person living in your basement and they're worried about AI, I would show them this chart and I would say, I would learn how to use it. I would become really good at it. I would go get a job in this field. Then I would call Joe Massey and get pre-approved for a loan and move out of my house. Right?
Yeah,
Like,
exactly.
I think there's actually an opportunity here that you don't realize. So I really like this chart. I think there's
a
there's
lot
an
of
opportunity
information
for young
packed
people.
into it.
Yeah. We think it's going to take our jobs, but it's actually creating them. This is so impactful. Thanks for sharing this.
Yeah. Thanks for looking at it with me. So part of negative sentiment for consumers is probably because of the perception of high inflation. And you can see that inflation was actually very high about 2 or 3 months ago and it's starting to come down a little bit. Interestingly enough, the most interesting recent report shows that inflation is cooling off. It was actually a little bit below overall estimates. If you took a look at the Federal Reserve estimate for where they think inflation is going to be at the end of the year, it went down on most recent revision as well. So those were very encouraging. This is the swap rate. So this is a financial tool that's traded on Wall Street for people who don't want to be in a position where they're at the mercy of what inflation does or does not do over the next 12 months or 5 years or 10 years. And they want a firm contract locking in what rate of inflation they're going to have so they can plan with concrete around that. So you've got traders with billions of dollars at stake placing these financial commitments. So it's a very well thought out process. It's not something that happens just like putting a $20 bet on the Broncos. The swap rate right now for inflation for the next 12 months is under 2%. So if you're worried an awful lot about inflation, I would challenge you to think through what evidence you're using to formulate that opinion. And look at what Wall Street guys with billions of dollars they've got to place accurately. This is their judgment. And if it impacts your analysis, maybe just think through one additional scenario.
Yeah, I kind of like this. We don't have access to all the different things that they could figure out, but we can see what they're doing, and they're probably pretty smart guys.
Yeah.
They didn't get that job for nothing.
That's right. That's right.
All right, this shows you the unemployment rate. So you can see it's been pretty steady around 4%, increasing very, very gradually. It's gone down over the last couple of weeks. Not early enough to call it a trend, but by no means is unemployment continuing to go up. It looks like it's stabilized to me.
Yep.
Sooner or later, both of these drivers of consumer confidence should improve, which will lead to more buying activity in the marketplace. The number of job openings has increased lately, so hopefully that's the start of a new trend. And that would, of course, put more downward pressure on the unemployment rate. So what about growth? So the reality is that the economy is still growing. I don't think I did. So the lower right, this is the Atlanta Federal Reserve. This is their forecast of what the GDP growth is going to be over the next couple of quarters. They're expecting somewhere between the 2 to 3% range. Interestingly, if you do a survey of consumers and ask, is there going to be a recession in the next 12 months? 2/3 of Americans think we're going to have a recession versus the economists all think we're going to continue to have a pretty good economy. I actually agree with that. I think the economy is doing fine.
One thing I love about this slide, the pie chart, nearly two in three Americans think a recession is coming in the next 12 months. We've had this slide for more than 2 years. But if you survey these same people, they still say, oh, there's going to be a recession in the next 12 months. It tickles me every time we see it.
I think
So
it's
when
an
you look at
important.
consumer confidence being so negative, this is a big thing that's weighing on it. People think there's going to be a recession. I'm not going to buy a house now. I'm going to wait.
Right.
I think that's an important point to make because you mentioned 2 years, Joe, and I just think that this is an ongoing thing where we're seeing a huge gap between how people are feeling and then what the actual data presents. I mean, in actuality, right, the people that are answering the surveys, they're going off of feeling. They're not necessarily looking at, well, what do the economist data say? I'm going to change my opinion because of what they're saying. I think this is going to continue to be a gap that we're going to see for a while. I think for many years, we might still have this slide up here because people might still feel like a recession's coming, even though the economy is still doing well and unemployment's doing really well. So it'd be very interesting to see how long we keep this slide here and how long, this data remains pretty consistent if it does.
Yeah.
It certainly will be. Okay. So a couple of national trends. There's more sellers active than there are buyers, and that's still true. I've had a version of this slide around for probably 4 or 5 months now. But most of the slowness in the market that we observe is the oversupply of sellers.
Mm-hmm.
So the National Association of Realtors, you always have to understand there's some bias in who's giving you the forecast. No one's going to have a more bullish forecast than the NAR is going to, but they actually did reduce some of their numbers of what they're expecting this year. Still overall pretty positive is what they think. So what's interesting is that sellers are taking their listings off the market at the fastest pace that they have in years. And I highlighted Denver on here. Someone here is in Northern Virginia, so I'll see if I can find Washington, D.C. really quick. I'm not seeing it.
It's right underneath Denver. It's just to the right of Denver.
Oh, there you go. So D.C. and Denver are twins.
Yep.
But the number of homes coming off the market is relatively high right now.
Mm-hmm.
So why are there more delistings? Well, there's 3 big drivers of that. We've got a lot of inventory growth. We've got a change in prices. And we've got longer marketing times. So if you look at inventory for the entire U.S., it's on the left side. You can see that our bottom dead center was kind of near the end of 2021, right before interest rates started to go up for mortgages, and that the inventory has gone up from around 250,000 to 800,000 units. So it's like a tripling in the amount of inventory.
Mm-hmm.
But if you compare that to what the working level of inventory was before COVID, overall for the US, we have less inventory now than we did pre-COVID. As opposed to if you look at Denver, you could take a look at the dotted line going across on the right. That was our pre-COVID sort of normal inventory level. About 9,000, 9,500 listings on the market. We're closer to 12,500 right now. So Denver's had a lot more inventory build than most markets in the U.S., and that's why Denver's market is a lot slower. I don't have this data for D.C., but looking at the number of delistings you've got in D.C. being just about the same as Denver, I imagine that D.C.'s numbers are probably relatively similar to that.
Yeah.
So 80% of sellers, if you ask them, are you going to get your asking price? You're going to get more than your asking price. 80% think they're going to do better. And only like 12% think they're going to get less than their asking price. The reality is that 62% of homes sell for less than asking price. So there's a growing gap between seller expectations of what things will sell for and what the market's willing to pay. Some of the sellers aren't willing to make the price adjustments that are required. That leads to more homes getting pulled off the market, not getting sold. And that's probably the biggest of the drivers of why you're seeing more delistings right now. And frankly, we've got enough inventory, so more delistings is a favorable thing for the people who are
that's great.
So the number of price reductions is, generally speaking, increasing. It's higher in the West than it is in other regions of the U.S. And no surprise.
I love this slide. When this got added a month or two, this is a great slide.
Yeah, the longer you wait, the lower the price you get. It's always been that way, but the steepness of the curve has gotten a lot worse.
Wow.
For a sale listing. Joe, do you have any thoughts on this one?
Just the number was just shocking to me when I saw it.
Yeah.
If you have a $400,000 home and it's overpriced and it takes you more than 120 days to sell it, you're going to lose $55,000 in your sales price.
Brutal.
Whereas maybe we should have just listed it for $360 on day one. I think this is such an eye-opening slide. And I've actually seen several of these. I was teaching my team some stuff on looking at overpriced listings the other day. and we found a condo over in Belmar. It was purchased. I'm sorry, it's a little side story. It was purchased 3 years ago for $465. They listed it for $480 4 months ago. They've now got it down to $424 and no activity. And it's literally, it could be like this example, and they priced it too high just because they wanted to try and make a little bit of money compared to what they paid 3 years ago. They did not. What you paid for the property in the past does not impact what is the market value today. And this is such a valuable slide. So agents on the call, please hang on to this, share this with your sellers. I think this is a critical piece of information.
Yeah. If you have any questions, definitely drop them in the chat box. We're happy to try to entertain questions you have. Marketing times are up across the U.S. I mean, not like by dramatic amounts, but they are up somewhat. So why do people change homes? Well, the number of life-changing events in a 2-year span, here are the big ones that drive it. Births, people retiring, deaths, marriages, and divorces. Probably all the things you probably would have typically expected. So if you ask the recent buyer pool, what prompted the most recent move that you made, here's all the reasons they gave. Only 28% said nothing. So 72% something significant. So if you're in a low interest rate environment, but you've got a change in job, you've got to move, you're going to get a new house in your new city, regardless of how great your old interest rate was. And that's rewinding a couple slides back when Joe was talking about how the number of people with a mortgage above 6% has gone from like nearly zero to like 20-25%. This chart explains why that happened.
Yep. They still need a place to live.
Yep. Most people want to be closer to friends and relatives and family. And then you see the other reasons. They're all the exact same things that you'd expect.
Yeah. Well, can you go back to that slide? Notice what's not on here. There's not a slide that said, I bought a home because of a great interest rate, or there's not a line for that, right? People buy
never comes up.
It never comes up. Why'd you buy a house? Because rates were low. No, you bought a house because you need shelter, because you need to live closer to work, because you need another bedroom, whatever. So I think, again, back to what we're talking about, we get that objection in our mind, but focus on why does the client want to buy a house? Why are they speaking to us? Why do they want to sell? Find the why behind the why.
Yep.
I'll get off my soapbox now.
No, I'm all with you on that. So this chart just shows you the number of homes being sold by month, by year. So if you look at the bottom of the chart, you can see 2022, 23, 24, and 25. So those are the post-COVID years when we were off the big sugar rush. And about halfway through the chart, you can see 2026. So 2026 sales counts are actually a little bit better than they were during the last couple of years of post-COVID, but we're nowhere close to the normal rate. If you look in the middle of the chart, you see the orange line, that's 2019. And I took out a couple of years just to simplify the chart. It was a very busy chart, but I also put in 2015 just to illustrate. That's the pre-COVID normal rate that we had been at for quite a long time. So you see 2026, our pace of sales for the US has improved from the bust, but we have a long ways to go to get to the typical normal sort of rate. And if you look at the top of the chart, you got 2020 and 21 when we had the sugar rush of super duper cheap interest rates. We sold an absolutely insane number of houses. We're not going to get back to that level of sales probably in my lifetime, but it was really fun to be part of it when it lasted. Well, it's fun if you were a seller, not so much fun if you were a buyer.
Hey, I work only with buyers. It was pretty fun for me too.
That's right. You got a lot of deals done, which was fantastic. A lot of refis too. So if you take a look at how home prices are changing across the U.S., there's a lot of diversity depending on which part of the country that you're in. So I highlighted Denver for you. You can see that prices are down a little bit. That's largely a factor of the fact that we've had more interest rate increase than just about anybody else. If you look at Washington, D.C., it's about break even.
Right in the middle.
So one guess from that market. But generally speaking, the Midwest and the Northeast have had the least amount of inventory build, and those are also the markets that have seen the most amount of price appreciation. Conversely, the Southeast and the Western states have had the most amount of home inventory growth, Denver being a prime example, and they're having the least amount of home price appreciation. So depending on where you're at in the country as you listen, you can use that kind of as a guidance as to what's going on. Milwaukee, number one.
What's
Buffalo.
going on there?
I don't know. It's a good, solid Midwestern place. So you can see an inventory build in Colorado is 37% higher than it was pre-COVID. Washington is up 47%. On the other end of the axis, who's got the least amount of inventory relative to the normal of pre-COVID? And the answer is Illinois, Connecticut, New Jersey, operating with less than a half. So no particular surprise that those markets are doing well from an appreciation standpoint. It's just not a lot for buyers to buy.
Mm.
And here's what the prices are doing. So you'll recall that the red circles are the markets that had the most inventory build. So they've got the softest prices. And then you remember that the green circles were the markets that had the least amount of inventory. And not surprisingly, like they're kicking ass. Like the national average appreciation last year has been about 1.7%. Illinois is at 7%, Vermont's at 5%, Connecticut at 5%, New Jersey at 4.5%. So it's just supply and demand. If you have too many houses on the market, you're going to have soft price growth.
Yeah.
One thing I want to point out here, we still hear people talk about when is the foreclosure boom going to happen? I'm waiting for the foreclosure crisis. I'm waiting till, all the foreclosures are available. Guys, price depreciation of 2.4% here in Colorado, 0.5% in California, that is not an indication of a foreclosure crisis. If you have clients talking about that, we've got some other slides that Nick and I presented, I think, last month. Go back to that recording. There's not going to be a foreclosure boom. There isn't. This is
Too much equity.
This is a natural reversion to the mean of appreciation. And Lon hit the nail on the head. There's too much equity. So don't expect a foreclosure crisis anytime soon.
Yep, there you have it. And I think that's all I've got here. So if you are a realtor and you know investors that are active landlords and they'd like to be passive, go to this website. We've got some tools for you to get some new listings. We're delighted to help you out with that.
Mm-hmm.
I think, and if you're interested in investing passively, I wrote a book on passive investing, and here's how you get a free copy of it.